What is depreciation for rental property expenses? Imagine owning a rental property and wondering how to make the most of your tax benefits. Well, depreciation is a key tool that can help you do just that. It might sound complicated, but it's really about spreading out the cost of your property over time. When you buy a rental property, the IRS does not let you deduct the full purchase price in the year of purchase. Instead, you can recover that cost gradually over many years. This process is called depreciation. It is a way to account for the wear and tear, aging, or obsolescence of the property as it earns you rental income. Think of it as a way to balance out the expenses and income from your rental over time. The main idea is that your property has a useful life, which for residential rental properties is 27.5 years. You start by calculating your cost basis, which is the purchase price plus certain costs like closing fees and improvements, minus the land value. For example, if you buy a house for $300,000, pay $10,000 in closing costs, spend $5,000 on a new roof, and the land is worth $50,000, your cost basis is $265,000. You then divide this amount by 27.5 years to find your yearly depreciation. In this case, it would be about $9,636 each year. This amount is deducted from your rental income, lowering your taxable income. The IRS uses a system called Modified Accelerated Cost Recovery System to handle depreciation. For residential rentals, the most common method is straight-line depreciation, which means you deduct the same amount each year. There is also a mid-month convention, which means no matter when you start renting the property during the month, depreciation is calculated as if the property was placed in service in the middle of that month. So if you start renting in May, you get a partial deduction for that first year based on the number of months the property was in use. In the first year, you only claim depreciation for the months the property was rented out. If you sell or stop renting the property before the year ends, you can also claim a partial depreciation for that final year. When you purchase improvements like a new roof or windows, those costs can be included in your depreciation calculations, but land costs cannot. You cannot depreciate land because it does not wear out or become obsolete. Depreciation is a powerful way to reduce your tax bill each year. It helps you keep more of your rental income, but when you sell the property, you might have to pay depreciation recapture, tax on the total depreciation you claimed. That's why keeping detailed records of your costs and dates is so important. It ensures you claim the right amount of depreciation and are prepared for any tax questions later on. Understanding depreciation can make a big difference in your rental property finances. It's a smart way to make your investment work harder for you by lowering your taxable income each year. Just remember, always consult a tax professional to make sure you're applying the rules correctly and getting the most benefit from your rental expenses.